Good news for American seniors. Starting with your 2025 tax return, if you're 65 or older, you can claim a brand new $6,000 additional tax deduction. And this is completely separate from your regular senior deduction. I'm going to explain exactly how this new law works, who qualifies, and the important IRA changes you need to know about before tax season begins. This groundbreaking change comes from the One Big Beautiful Bill Act that was enacted on July 4, 2025, and it represents the most significant tax relief specifically designed for seniors in decades. Understanding this new law is crucial because it could potentially save you thousands of dollars on your 2025 tax return. But there are specific income requirements and deadlines you absolutely must know about. The new $6,000 senior deduction is available for tax years 2025 through 2028, meaning this is a temporary but substantial benefit. What makes this especially valuable is that this $6,000 deduction is completely separate from the existing extra standard deduction that seniors already receive. For 2025, that existing senior bonus is $2,000 for single taxpayers and $1,600 per qualifying spouse for married couples filing jointly. This means you can claim both deductions simultaneously, maximizing your tax savings. Here's where it gets important for your financial planning. For 2025, the total standard plus bonus deduction for those age 65 and older reaches $21,750 for a single person and $43,500 for a married couple filing jointly. However, you need to pay close attention to the income limits because they directly affect your eligibility. The $6,000 deduction starts to decrease for taxpayers with a modified adjusted gross income over $75,000 for single filers, or $150,000 for married couples filing jointly. If your income exceeds these thresholds, you'll receive a reduced benefit, and at higher income levels, the deduction phases out completely. Let me explain how this impacts your Social Security benefits, which is a concern many of you have shared in the comments section. This new law provides a temporary, income-based bonus deduction rather than a full repeal of Social Security benefit taxes. But that deduction boost could, for some, indirectly impact how much Social Security income is subject to tax. This means while your Social Security benefits themselves haven't changed in terms of taxation rules, the larger overall deduction could reduce your total taxable income, potentially putting you in a lower tax bracket and reducing the portion of your Social Security that gets taxed. For those of you receiving SSI, SSDI, or VA benefits, this tax change works alongside your existing benefits without affecting their amounts. Your Social Security disability insurance and supplemental security income payments remain unchanged, and this deduction simply reduces your taxable income when you file your return. Veterans receiving VA disability compensation, which is already tax-free, won't see their benefits affected, but any other taxable income you have could benefit from this new deduction. Now let's talk about the crucial IRA and Roth IRA updates that coincide with this tax law change. For both 2024 and 2025, the maximum annual contribution limit remains $7,000 if you're under age 50 and $8,000 if you're age 50 or older with the catch-up contribution. What's particularly exciting for those in the 60-63 age range is that under changes made in Secure 2.0, 0. Employees aged 60, 61, 62, and 63 who participate in employer retirement plans can make higher catch-up contributions of $11,250 instead of the standard $7,500 for 2025. For Roth IRA contributions, the income limits have been adjusted for 2025, which affects many seniors who continue working or have significant retirement income. You can make a full Roth IRA contribution in 2025 if you're a single filer with income less than $150,000, or if you're married filing jointly with income less than $236,000. If you're a single filer with income between $150,000 and $165,000, you can still contribute a partial amount, which phases out completely above $165,000. This is particularly relevant if you're planning your Medicare enrollment or managing your Medicare premiums, because your modified adjusted gross income affects your Medicare Part B and Part D costs. The new $6,000 deduction could potentially lower your MAGI enough to reduce these Medicare surcharges, creating additional savings beyond just your income tax reduction. For those of you who've been asking about stimulus checks or additional pandemic-related benefits, it's important to understand that this $6,000 deduction is an ongoing tax benefit, not a one-time payment. Unlike previous stimulus payments that were direct deposits, this benefit reduces your tax liability when you file your return, which could result in a larger refund or lower tax bill depending on your situation. I know many of you are concerned about the complexity of tax changes, and rightfully so. The key thing to remember is that this deduction works automatically when you file your tax return. You don't need to apply separately or provide additional documentation beyond proving your age. However, you do need to ensure your tax preparer or tax software knows about this new provision, as some may not be immediately updated with these changes. One concern I've been hearing from many seniors in my comments section is about the temporary nature of this benefit. Since the law currently expires after 2028, it's crucial to take advantage of this deduction for the next 4 tax years. This is also why it's important to plan your retirement income strategically during this period, potentially accelerating some income or conversions while this beneficial tax treatment is available. If you're managing multiple income streams, perhaps Social Security, a pension, IRA withdrawals, and part-time work, this deduction becomes even more valuable because it applies to your total taxable income. For example, if you're a single filer with $60,000 in combined income, this deduction could reduce your taxable income to $54,000, potentially moving you to a lower tax bracket and reducing your overall tax rate on all your income. Please share your experiences in the comments below. Are you planning to adjust your retirement planning based on these changes? Have you spoken with your tax professional about how this affects your specific situation? Your insights help other viewers understand how these changes work in real-world scenarios, and I read every comment to understand what topics you'd like me to cover next. For those receiving VA benefits, remember that while your disability compensation remains tax-free, any pension or other VA benefits you receive could be affected by your overall tax picture. This new deduction might help offset taxes on other retirement income, making your overall financial situation more favorable during these 4 years when the benefit is available. Medicare recipients should pay special attention to how this deduction affects their income reporting, because lower taxable income could result in reduced Medicare premiums in future years. The Income-Related Monthly Adjustment Amount, or IRMA, that affects Medicare Part B and Part D premiums is based on your tax return from 2 years prior, so the benefits of this deduction could compound over time. If you found this information helpful, please hit that like button and subscribe for more updates on senior benefits and tax changes. I know these topics can be overwhelming, but staying informed helps you make the best decisions for your financial security. Make sure you turn on notifications because I'll be covering more changes as we get closer to tax season, including specific examples and scenarios that might apply to your situation. To wrap up, remember that this new $6,000 deduction is available for 2025 through 2028 for anyone 65 or older, with income limits starting at $75,000 for singles and $150,000 for married couples. It's in addition to your regular senior deduction, and it could significantly reduce your tax burden. The IRA contribution limits remain steady, but there are enhanced catch-up contributions for those in their early 60s. Your next steps should be to contact your tax professional to discuss how this affects your specific situation, or if you prepare your own taxes, make sure your software will be updated for these changes. Check your projected 2025 income to see if you qualify for the full deduction and consider whether any year-end tax planning moves make sense. If you receive Social Security, SSI, SSDI, or VA benefits, remember that this deduction works alongside those benefits to potentially reduce your overall tax burden. Keep all your tax documents organized and don't hesitate to reach out to the IRS or Social Security Administration if you have questions about how these changes affect your specific benefits. Stay informed, stay prepared, and remember that these changes are designed to help you keep more of your hard-earned money during your retirement years.